Hey everybody, Rob Maurer here, and today we're going to be talking about a couple of product updates from Tesla. We also have some comments from Elon on FSD and future plans there, similar on Tesla Solar. We've got a couple of things on the stock, and then I do want to take a second to do a little bit of a deeper dive on that episode yesterday, the comparison with Amazon. A few questions on that I wanted to answer, and a few extensions to that comparison that I think are also pretty interesting. Then we do have some other items as well. Alright, so strong close to the week for the markets. The Nasdaq today actually finishing up 3.1%, by far the best day so far this year. Previously, the best day was up 1.4%. As for Tesla, not quite as strong, but still a decent day, trailing the Nasdaq, but up 2.1% to close at $846.35. One quick note while we are on the stock, since I know some people like to keep track of this, yesterday was the first time in quite some time for ARK Invest to buy Tesla stock after only selling or holding for a while. They added about 33,000 shares. Normally, I don't really care too much about that, but I will note that Elon did like a tweet of a Tasmanian article about this action, and it said, ARK buys $28 million worth of Tesla shares, taking advantage of recent price decline. If we want to maybe make an inference on that, could be seen as maybe Elon saying that, yep, this is probably a good opportunity to buy Tesla stock. All right, we've got a couple of pretty interesting updates here from TeslaScope on Twitter to kick off the news for today. The first is a new product from Tesla, and it relates to that trademark that we had covered a week back or so that Tesla had filed for audio-related equipment. Looks like we're already seeing the first of those. Tesla is now selling a microphone in China. I was having some trouble getting the Tesla China store page to open, so I can't open that page and see the product details, but TeslaScope did share a photo of this in the box, so it definitely looks legitimate. It looks like the price is around $190 equivalent, and from this photo we can see that there are two mics in the pack, so I assume that is the price for the set. Looks like the intended use case would be for in-car features like karaoke. I would imagine it probably also works well with the external speaker. I've actually been in an Uber before that had sort of a karaoke machine with mics set up, and in that Uber people liked it, so you can definitely see some people getting a kick out of this. Kind of a nice little fun product. We'll see if it expands beyond just the China shop. The other update that TeslaScope has is, I guess, a preview of a possible new feature from Tesla, which would allow users to change the displayed color of their vehicle, both on the vehicle interface as well as in the mobile app. Definitely a nice feature for people to have that have either had their cars repainted or have gotten it wrapped. This is definitely one of those things that I could see companies charging for, just as like a novelty feature that obviously has no marginal cost, but that people that have either repainted or wrapped their cars probably would end up paying for. Little cosmetic changes like that are how a lot of video games make their money with customized skins and things like that. And I do think Tesla could make some pretty decent money doing that, but for the scale of Tesla's business, it's probably just not significant enough to trade off for the goodwill that they would receive from just having a feature like this built in, unless there were a roadmap for many more features like this, which would actually become then sizable to profitability. Anyway, a couple of fun updates there for Friday. Next, we've got some comments from Elon on FSD. Last night, in reply to Stephen Mark Ryan, Elon tweeted, and there is a flipped word in here, but I'll just quote it directly. It says, quote, "Given how hard and insanely FSD is, I think it may take 5 years or more before any company besides Tesla solves it," end quote. Elon then also added on today that, quote, "Tesla will support FSD licensing by other manufacturers," end quote. So some conversation about that, but just pointing out that Elon has made that comment before, so really no change in his stance on licensing FSD. Tesla talks a lot about how safety is a huge priority for the company, so it would be a little bit hypocritical of them to not offer that if FSD does make vehicles safer. But at the same time, Elon has made comments that alluded to the fact that he does feel like the company that solves this should be rewarded for that. So Tesla is not just going to give it away for free, especially to other companies that maybe aren't doing as much in terms of electric vehicles. I would doubt that Tesla would license it out to ICE vehicles, but I guess a lot of that would kind of depend on the context in the market at whatever point in time that decision needs to be made. Not something I think that's worth spending a whole lot of time right now on, because again, if Tesla solves FSD, well, any investor is going to be significantly rewarded for that. So really things like this are just a question of how much that reward would eventually be. And because the upside is already so high, I don't think that's really all that important of a question at this stage. Elon did also have a comment on the solar business. They didn't really talk too much about that on the earnings call this time around. But Elon did reply to a different Tasmanian article talking about how Tesla grew solar deployments year over year by 68%. And Elon said, "Excited for future of solar at Tesla." So it's still there. It did have a couple of down years back when the Model 3 was ramping up and kind of bottomed out in 2019, returned to growth in 2020, and then even higher growth this year. So hopefully that trend that we see this year can continue, and that can get back to being a little bit more exciting piece of the puzzle. All right, next here, I wanted to revisit the Amazon comparison yesterday. I got quite a few comments and questions on one particular piece of this, and that was that back in 2016, Amazon had a much smaller market cap and less than half the amount of outstanding shares that Tesla currently has. So with varying degrees of politeness, people challenging the validity of that comparison. Because so many people had this question, I wanted to spend a couple minutes clarifying it, and some of this will be very basic review for many of you, but stick around because there are other things after this that I want to discuss that I also think are pretty important. So anyway, first off, the comparison that we made yesterday is completely valid. We're looking at earnings per share and price per share, otherwise known as the stock price. That is the price per share, which at a very basic level is just the market cap divided by the share count. Just like earnings per share is net income divided by the share count. Because all of the metrics that we were looking at are divided by the share count, it normalizes the difference in share count. So I just did a very, very basic example here. Company A and Company T. Company A earning $2,500 per year, Company T earning twice that amount. Company A has 500 outstanding shares, Company T has twice that amount at 1,000. So in both cases here, dividing total earnings by outstanding shares yields $5 of earnings per share. Now, if both companies carry a 50 times price to earnings ratio, Company A will have a $125,000 market cap, Company T would have a $250,000 market cap. Then to get the price per share, you would divide the market cap by the share count. Both of them come out at $250. If both of these companies double their earnings and continue trading at that same 50 times price to earning multiple, both companies would then have a share price of $500 per share, doubled from where it was. So yesterday when we're talking about Amazon having $4.90 of earnings per share and a share price of $830, and Tesla being the exact same, and then a year from then, when Amazon reported $6.15 of earnings, but the share price was at $1,400, if the market priced Tesla at the same earnings multiple, which was kind of the whole point that we were making, then the Tesla share price would also be $1,400 per share. Yes, the market cap would be higher, but earnings would be as well. You're just dividing it out into more pieces. It just so happened to work out in this case that Amazon and Tesla had both the same earnings and share price. I think that's probably responsible for some of the confusion here. But even if they weren't, you can always make these types of comparisons. Oftentimes you just have to do a little bit of multiplication or division. So let's say that Company T had a stock split, 1 for 5. Everything else is exactly the same. You just now have 5,000 shares instead of 1,000 from before. So your total earnings of 5,000, that's now $1 per share, but everybody has 5 times more shares, which are priced at $50 per share instead of the $250 that they started at. It's all the same stuff. And you could get back to making the exact same comparisons that we were making before, getting back to that levelized starting position, which is basically what we just naturally happen to have. You would just need to mentally convert, divide the outstanding shares by 5, multiply earnings per share and price per share by 5 as well. It's all just algebra. I promise it all works. The only thing to be aware of in circumstances like this is that the size of the company does matter, because a bigger company has potentially less room to grow, right? So you do need to understand that. You probably wouldn't want to compare a $5 trillion company with a $100 million company in the same way, but I think Amazon at that point in time, Tesla right now, close enough to make the comparison pretty valid. Obviously, no comparison between two businesses is ever going to be perfect. There's always all this context that goes along with it. But to me, I think this is strongly informative, and maybe you don't agree, and that's okay. Diving deeper on that question of, okay, Tesla being a larger market cap company, let's look at some of the numbers here because I think these are pretty interesting too. Amazon in 2016 was doing $136 billion in revenue, and their GAAP net income was $2.4 billion. So we're getting out of the per share stuff now. We're just going to look at it on a total business perspective. If we look at those numbers for Tesla this year, Tesla posted $54 billion in revenue and $5.5 billion in GAAP net income. So yes, Tesla does have a bigger market cap than Amazon had at that point in time, which might lead you to believe that Tesla has less upside than Amazon had at that period of time. But I think that would be a hasty conclusion to make because, as we see, Tesla right now has less than half of the level of revenue that Amazon had back in 2016. And even though Tesla's business is smaller scale, smaller revenue base, they're earning more than twice as much as what Amazon was. Personally, I believe that Tesla has a much larger total addressable market as well. That's why the growth outlook can continue to be as high or even higher than Amazon was at that stage in their business back in 2016. That's why I believe that Tesla can carry a similar or higher multiple, and eventually that multiple is what brings us back to the per share comparisons. So to an extent, questioning that comparison is valid. It's not because of how the math works out. It's about the size of the companies and what their respective total addressable markets and growth outlooks are. If Tesla didn't have that strong outlook, then yes, it would be a very bad and flawed comparison to make, but my opinion is that it does, and I think I probably just kind of gloss over that because I feel so strongly about it. Additionally, as I did mention yesterday, we're talking about 2 different periods of time here, so 2 different macro environments, and that is very important. But one data point that is very interesting from that period of time is that the Fed was in the process of raising interest rates during that start of 2017 to 2019 time period that we were looking at. Obviously, there's a lot more that goes into the macro environment than just the federal funds rate. Doesn't mean the macro environment is the same or going to be the same now. It never really is, but it does also demonstrate that high growth, high multiple companies can be successful investments during periods of time of interest rate increases. So I don't know, hopefully all of that is helpful to at least some extent. It was nice to see a lot of those comments and questions yesterday to kind of keep this discussion going. So definitely if you have other questions, let me know in the comments today. One other quick point that I did want to make while we're kind of talking about earnings related stuff here is on Tesla's guidance. So we talked yesterday a lot about the CEO compensation plan. Tesla saying that they're recognizing the last 2 milestones as probable of achievement. One of those was hitting $14 billion in annualized EBITDA. That was pretty obviously going to happen. But the other one that was sort of on the fence was $75 billion in annual revenue. So Tesla marking that as probable means that for the next 12 months, their internal forecast is higher than that number. So yes, we know Tesla talked about 50% more vehicle deliveries, but this also implies that revenue would grow at least 40% this year. Nothing groundbreaking there, but sometimes Wall Street expects Tesla's average selling price to drop to such a degree that revenue growth would slow dramatically because of that. And we have seen Tesla's average selling prices decline over time. So the distinction between the 50% delivery growth and a different number for revenue growth is an important one to consider. So just wanted to make sure that that was pointed out. And to be clear, I'm not saying that Tesla wouldn't grow revenue at 50% or more. I'm just saying that they're saying here that it will be at least 40%. All right, last couple of things here as we wrap up the week. Let's look ahead to next week. Next week is the beginning of Chinese New Year, so there should be some downtime at Giga Shanghai. We'll kind of try to keep an eye out for how that might impact February production numbers and see if we can't get a better understanding of what that scheduling looks like. Then, of course, big earnings week again next week. So GM on Tuesday, Ford on Thursday, Amazon on Thursday as well. Automaker reports should be interesting and lend for a lot of comparisons between Tesla's performance this year and theirs. We'll see how the market reacts. Didn't really seem to like Tesla saying that they're going to maximize the efficiency on one product line and earn a ton of profit from it. For whatever reason, those intraday reactions seem to be a little bit more excited about announcing, 25 different variants that they can't produce and spending billions of dollars on those. Lastly for today then, I'll just leave you with a couple of new photos of the Cybertruck that have surfaced as the Cybertruck continues to be at Giga Texas. With that, I hope everybody has a great weekend. As always, thank you for listening. Make sure you are subscribed and signed up for notifications. You can also find me on Twitter at Tesla Podcast. And if you're interested in supporting what I'm doing here, you can find details about doing that at patreon.com/Tesla Daily Podcast. We'll see you again on Monday for the January 31st episode of Tesla Daily. Thank you.